In this video, we'll continue our discussion about adjusting entries. In this video, we're going to focus on a second category of adjusting entries, accrued expenses. So recall the accrual basis is required by GAAP, and under the accrual basis, we're going to record revenues in the period when the performance obligation is satisfied, regardless of when the cash is received, and we're going to match expenses against revenues that it helps to generate in that accounting period, regardless of when the cash is paid. Accrued expenses are expenses that have been incurred but not paid. So examples of accrued expenses include interest incurred on money borrowed. So you go to the bank, you borrow money, they're charging you 10% interest. You could make an entry every single day to record 1 day's worth of interest, but as we've discussed before, it really doesn't matter that the interest expense account is up to date until the end of the accounting period when you get ready to prepare your financial statements. And at that point, you need to recognize that in addition to the amount of money that you borrowed, you owe an additional amount for interest, and that needs to be recorded in an adjusting entry. So that's an example of an accrued expense. You have incurred that interest expense, but you haven't paid it yet. Another example is salaries earned but not yet paid. So for example, if we pay our employees for a 5-day work week every Friday and the end of the month falls on a Tuesday, our employees will have worked Monday and Tuesday, the last 2 days of the accounting period. We're not going to pay them because it's Tuesday, not Friday, but we need to record that they have earned 2 more days worth of salaries. So we have incurred that expense, but we haven't paid it. But we want salaries expense to reflect the expense all the way up through the end of the accounting period, not just through the last payday, so we need to make an adjusting entry. Typically, a utility bill is going to arrive at the beginning of the next month. So if we're looking at the month of August, we'll probably get our utility bill for August in early September and pay it later on in September. But we know we have incurred utilities expense because the lights have been on. So we need to make an adjusting entry to accrue that kind of expense as well. The adjusting entry to accrue an expense is always going to be a debit to an expense account and a credit to a liability account, and more specifically, a payable, because this is a cost that we have incurred but not yet paid, so we owe it. So like most liability accounts, it's going to have the word payable on the end. So interest payable, salary payable, utilities payable. So we're going to be increasing an expense account with that debit and increasing a liability account with that credit. So going back to our example problem, if you take a look here, we have a note payable for $5,000 on our unadjusted trial balance. But because it is an unadjusted trial balance, we have nothing in the interest payable account and nothing in the interest expense account. So we're going to need to make an adjusting entry. We're going to need to figure out how much interest we have incurred on that note and make an adjusting entry for that. So the note payable has a principal amount of $5,000. It was signed on August 1. It has an interest rate of 12% and a term of 3 years. So we're going to assume that we're going to pay the interest back when we pay the note back. When you're given an interest rate by law, it has to be expressed as an annual rate. So that is a 12% annual rate. So when we calculate interest, we take the principal, we multiply it times the rate, and then times time. So if we were doing interest for an entire year, we would say 5,000 times 12% times 1, or 12 over 12, 12 months over 12 months. We only want interest for 1 month here, So we're going to say 5,000 times 12% times 1 over 12. So once again, that 12% is an annual rate. It's the rate for 12 months. We only want 1 month's worth of interest, so that's why the time factor is going to be 1 over 12 there. And we're going to get interest of $50. So then we're going to make our journal entry. We're going to debit interest expense for $50. We're going to credit interest payable for $50. So now we have the $5,000 balance in note payable. So that should only reflect the principal amount. You're going to put the interest that you owe in a separate account. And so we have interest here of $50, interest payable, interest expense. Debit to the expense account, credit to the payable account. A second example of an accrued expense is for our salary expense. So our employees are paid a total of $5,000 every Friday for a 5-day work week, and August 31 is on a Tuesday. So the employees got paid last Friday, but now they've worked Monday and Tuesday, so we have incurred 2 more days worth of salary expense. So we're going to take the $5,000 that we pay them for a 5-day work week. We're going to divide it by 5 days. It basically is going to work out to $1,000 per day times 2 days. So the amount we want to accrue is $2,000. So our adjusting entry here, debit to salary expense, credit to salary payable for $2,000. So our salary expense account already had a balance of $20,000 in it, and now we are increasing that $2,000 so that the salary expense account reflects salaries for the entire month, not just through the last payday, and then salary payable just reflects the amount that we owe.